With me now is David Bahnsen, the Chief Investment Officer at the Bahnsen Group. David, it's great to have you back. So drum roll, please. What do you think is the most important thing for investors to focus on these days?
Well, I'm a big stickler for dividend growth, and I think that free cash flow generation from which comes the growing, sustainable dividends that we love to see is itself the mark of a great, healthy company. So you kind of get two things at once. You get the actual benefit of the dividends into your account, either reinvesting for compounding, accumulation, or if you're an income-oriented investor, you're actually getting about 3 times the cash flow that you can get from the Treasury market or from the S&P 500. But you're getting it all from what I believe are higher quality companies, better balance sheets, and more stable business models.
Do you think dividend stocks, David, tend to benefit from this kind of stock screen selection? In other words, that people tend to want to own them because of the yield, or are they generally not in favor because they're not, the super high flyers, the FANG stocks, the trendy stocks of the day?
There's definitely no question that dividend growth was less in favor relative to FANG over those 4 or 5 years that FANG went to stratospheric valuations. But I think that over time, when you go back to, let's say, 1990, 30 years, the dividend growers isolated far outperformed the overall market. So the idea that people have to give up performance to go this route, I think, is misguided, but it is true in certain quarters or even certain years. But fundamentally, we think you get better companies, and the reason why is you avoid a lot of the big things that go wrong. We can focus on the success stories in high growth, high tech, but there's plenty of failures too, and you get to avoid a lot of those.
One more question before I ask you for some specific names here, but is it getting harder to find these dividend stocks because stock buybacks have become such a huge way for companies to sort of reinvest cash?
Yes, I mean, the one thing I would say is I don't believe a lot of companies doing high stock buybacks are reinvesting the cash. I think the bulk of it is going just to replace the stock they gave away in employee compensation. So I think that stock buybacks are largely driven by executive compensation from options and restricted stock. But there's definitely no question, especially in the technology suite, that a lot of companies prefer stock buybacks to or no capital return at all to dividends. However, if you look at the higher quality companies and you look at the more mature technology companies, you have not gotten the price return out of Cisco, Intel, IBM, but they got to a point where their cash flow generation was so high and the opportunities to go reinvest the cash so low, they became great dividend payers. Microsoft famously did it right after the time of the dividend tax cut about 15 years ago. So we think there are plenty of opportunities, but we have to go screen for them. And more importantly, Kelly, we have to continue screening because we don't trust them to keep the dividend going. It's our job to monitor it, to make sure that dividend growth is sustainable.